Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining us. And on the program tonight, we have Adam Dawes of Shaw & Partners, and clearly I'm going to talk to him about the sell-off of the stock market, but other buying opportunities. And then we'll talk to Mike Gable of Fairmont Equities, and Mike's going to look at a number of stocks and to see whether they're heading in the right direction or wrong direction, given the bank sell-off. And ironically, of course, our bank share prices have gone up because our banks are pretty good compared to most banks around the world. However, they still are causing problems for the market and some particular stocks in particular. Macquarie's one. And then finally, we'll talk to Paul Rickard, who is an ex-banker, and we'll talk to him about what he thinks is going on right now and whether this is actually a buying opportunity, or should we stay on the sidelines for a bit longer before we start having the courage to buy. That's the show. Let's now kick off with Adam Dawes of Shaw & Partners. Welcome to the program, mate.
Yeah, really good to be here. Thanks so much.
Bit tricky at the moment. So what's the market doing overall, and what are you saying to your clients about this banking crisis and how you play it?
Yeah, I think obviously when you've got these sort of downturns that we've had, I think that over the last sort of 4 or 5 months, the market's been running on sentiment, not really on earnings. And we certainly saw this through the last reporting season, earnings turning down and sentiment still staying high. But as we know, sentiment can turn on a dime, and that's exactly what we're seeing now. The sentiment now is following those earnings and potentially, or it is going lower. So what are we saying to the clients? I think, look, first of all, we're trying to calm people down. And I think that's the most important thing, is making sure that people aren't panicking out there. Because in our view, there's a very significant difference in credit quality or investment grade from the Australian banks versus European or the US banks. From that, we remain one of the best capitalized businesses, or capitalized in terms of liquidity and capital, much better than any of the other banks versus the regulators, with our CET1 ratio sitting around 11%. So in other words, we've got enough money there to support it. And this is exactly what I'm saying to clients. Also, that we have our Australian banking lending standards remain far more conservative, with just mortgage-backed lending still is the bulk of what is here in Australia versus some of the investment or the high-risk investments that they do have overseas. So I'm trying to calm people down. I'm trying to see that there's some opportunity. Certainly Macquarie today looking really, really good under that 170 mark, and potentially they might have some exposure to some of those Credit Suisse hybrids, I think was one of the rumours that was going around the floor today. But certainly CBA as well, with a 90 in front of it, somewhere around there, that 96. I think probably still got a little bit to go to the downside, but not much more. So I'm trying to be positive. The only other side of this is that if you looked at all of the banks, the 3 banks, Westpac, NAB and ANZ, and you put them up against the performance of the market over the last 10 years, they really haven't done anything. But when you get these big drawdown times in global banking areas, our banks actually outperform because of their conservative nature, AAA rating, and the CET1 ratios. So I think it's an absolute opportunity in this time to be picking up some of the good quality banks like Macquarie, like CBA, and that's what I'm saying to clients. I think this is an opportunity versus somewhere to be running and hiding at the moment.
Yeah, it's funny. When I saw the Aussie dollar up, I thought to myself, there'd be a bit of overseas buying of our banks, I would have thought.
I agree, 100%. Yeah, absolutely. And CBA was up most of the day today, now falling back with the rest of the market this afternoon.
Yeah, some of our smart clients wanted to buy CBA today. Let's go to what we've seen lately. I was going to ask you Macquarie, but you've already covered that. The tech rebound, as soon as the bank crisis hit, up goes tech stocks. Why don't you explain to my viewers why that probably is happening?
Yeah, look, you're absolutely right. The tech has rebounded, and even the NDQ, or the sort of NASDAQ 100, is up around about 16% from January 1 this year. So remember, it was down about 30% last year, and so it really has rebounded back. I think it is all really, and especially with this banking crisis, is that the market potentially thinks that interest rates aren't going to go up as quickly, or potentially they might slow that down with these crises going on. And that's a really positive for the tech space. Tech doesn't like higher interest rates. They like level interest rates. And in fact, they like reducing interest rates. And potentially we're one step closer with all this banking stuff that's going on. So there's some pre-buying going in Xero, certainly in some of the NASDAQ stocks. There's some good buying going into those because people are potentially seeing that the interest rates, the top of the hill, might be starting to slow down. And I think that's what the market's positioning themselves for another next 6 to 12 months.
Yeah. One of the points I made last week on Switzer Daily was, interest rates rises scare borrowers. Banking crises scare everyone.
Yeah.
That's going to help central banks beat inflation. It's going to be another weapon to make people less confident about spending and all that sort of. It adds caution, and I think that's what probably the central banks will be factoring into their discussions, particularly the Fed this week, and I think the Bank of England also is discussing interest rates this week.
Yeah, absolutely.
Okay, let's go to the miners. Now, a lot of the miners have been sold off. Some of it have gone up, like Liontown Resources. Let's talk about miners generally. Then I want you to tell us what you think about lithium stocks, because they'll say Liontown had a big week last week. At a time, some people think, there might be an oversupply of lithium. But let's just talk about our miners. There's been a bit of a sell-off linked to probably a deeper and more worrying global recession. But I'm kind of thinking, well, if they cut rates, there'll be a global rebound. Are the good miners like BHP getting into buy territory?
Yeah, look, there certainly are. I think, if you do that little bit of a look through from what BHP, Rio and Fortescue said through our reporting season last month, they basically said that we think second half conditions are going to get a little bit softer. We've reduced the dividends, so we're going to keep some more cash on the balance sheet. And commodity prices aren't going to be so elevated going forward. Now, remember, mining stocks, they are cyclical businesses. So there is a cycle to the commodity. Now, iron ore, we keep scratching our head at. It stays up at $120, $130. We're sort of scratching our heads why it's so high still at the moment. But we have seen certainly a lot of commodities just come back a bit. Copper, gold certainly hasn't with all of this unrest. It's continued to move higher and should definitely have gold in the portfolio for people. So I think you just got to be a little bit careful about some of the material stocks that you are investing in. And certainly something like a lithium has come under a fair bit of pressure because they're basically saying that lithium price has now started to come down. Now, they were getting around $80,000 a tonne for it. They're now getting around about $60,000 a tonne. And I think Credit Suisse, and there was another large, sorry, not Credit Suisse, we shouldn't really say that anymore, should we? Another large bank research house came out and said that they saw that the lithium price will get down to about $35,000. Now, remember, the big boys, IGO, PLS, these guys can make a ton of lithium for $5,000. So there is still a lot of profitability in the lithium space, even if the lithium price does come down to that 35,000. So you got to be careful about the commodity. It is a cycle, and you got to be positioning yourself in the right part of the cycle if you want to make good money in the resources space. I think it's going to be tough for the second half for resources, but it does provide us opportunity. And certainly that lithium story, I don't think is going to go away. Hence why you'd be comfortable to keep buying in that lithium sector. Okay,
I've got a lot of questions about Liontown Resources. Why did it do so well? Is it a standout company when it comes to lithium?
Yeah, I don't follow Liontown. I've got IGO, PLS, AKE, Alchem are my sort of three that I follow. Liontown's probably a little bit smaller. Maybe, I don't know, is the answer. But
yeah, certainly some smarties went for it last week. And let's go to any companies that you don't like. Given what you're seeing, given what you're predicting, what kind of companies would you like to lighten up on?
Yeah, so look, certainly we've been doing a bit of selling still in the consumer discretionary space. I think that's still going to be tough. Even if interest rates aren't going up as much, we still haven't seen the full effect of those interest rates on the consumer. So really cautious on the JB Hi-Fis, the Harvey Normans of the world. I don't think you need to be there. We could potentially start selling those. There's a couple of other stocks that we're sort of looking at in that sort of in the listed investment company space. I'm going through all of my listed investment companies and just looking at stuff that's not really hitting the NTA level or that's trading at a very large discount, taking it up, having a look at that, and then understanding, and then moving clients out of that as well. Some of those LICs are really languishing at the moment and haven't found a lot of luck there. But certainly keeping buying in the gold space, I think that's it's a bright spark, excuse the pun, on our market today.
Yeah, great stuff, mate. Thanks for joining us.
Thank you. Have a great one.
Same to you. And that was Adam Dawes of Shaw and Partners, and now we're going to Mike Gable of Fairmont Equities to see what he thinks is going on in the market right now, and particularly what stocks are doing. It's the right time to talk to Mike Gable with the market under a bit of pressure. And we're looking for stocks that are heading in the right direction despite it all. Mike, thanks for joining us.
Thanks, Peter.
All right, mate, let's kick off the way we always do. Let's look at the US market and what are you seeing there?
It actually doesn't look too bad. I mean, obviously, a lot has happened in the last sort of week and a bit with the bank failures, the huge drop in bond yields. So it seems as though everything's coming to a bit of a head. But when we look at the way the markets have traded, they've actually held in, I think, pretty well, despite all the fear mongering in the press. So if we have a look at the chart of the S&P 500, what I've done is I've circled what how it's traded since the failure of the Silicon Valley Bank, and as we could see, it's hardly worth mentioning really compared to what's transpired over the past year. So I think in terms of price action, it's looking pretty good. I mean, maybe that will change very dramatically in the next few days now that I've said this, but so far things are holding in pretty well, and we've had a chance for some major sell-offs and capitulations, but they're just not occurring at the moment.
Okay, well, let's go to the NASDAQ, where the action has been a lot more positive than people would have thought, and clearly the expectation must be that the Fed will slow down as interest rate rises, and that's going to be good for tech stocks. But is the chart basically reinforcing that message?
Yeah, it definitely is. So, on a shorter term basis, the NASDAQ's breaking out from a consolidation, and I've circled that there on the chart. So what that means is most likely it wants to head higher for the time being. So, despite all the headlines, what we've now got is a situation from where 2 weeks ago, everyone was saying there'll be a recession, interest rates will have to go to sky-high levels to kill inflation, and now everyone's still talking about recession. That hasn't changed, but the interest rate expectations have basically dropped back down to earth. Money printing's back on to bail out the banks. We're not going to see any. We're basically, it doesn't look like we're going to get a run on banks. So I think the setup is positive for equity markets, and possibly the catalyst for markets to actually get rallying may well be the Fed meeting this week. So whether they raise by 25, they keep it level. Some are even calling for a rate cut. But I think everything's coming to a head now, and I think this week's going to be fairly crucial for the next step. At the moment, it looks like markets want to head higher. I think if they breach the lows from December, then we will have some downside. But so far, looking fairly constructive.
Okay, let's go to the ASX 200, and of course, we've not only got the financial issues, but we've also got resource stocks as well, which can be affected if the recession is going to be closer and deeper than expected. So what's our market sort of showing compared to, say, the S&P 500?
Well, obviously we've fallen back quite a way since the start of February, but we're basically back to those lows at the beginning of January. And what I've done on this particular chart is, so on the right-hand side, I've circled the market basically now testing those lows from the start of the year. And I've also circled in the middle of the chart down at the bottom how the market reacted around the June lows. So as we could see, I mean, in my opinion, the market's looking very similar to the end of September last year. So end of September last year, the market fell back to the June low, bounced around for a few days, and then it was able to get going. And it actually looks like that's what we're doing now. We're sort of bouncing around the lows from early January. And, you know, I think that'll get resolved over the next few days. As I said, the Fed meeting in the next few days is likely to be the catalyst. And if markets react positively, that's the turnaround you'll be looking for. I think if we take out those January lows, then from a charting point of view, I then have to look back to sort of the mid 6,000s as the next possible level of support. But this seems to be the zone where, you know, we could get a decent move.
Yeah. So definitely what the Fed says on Wednesday US time and Thursday morning our time is going to be crucial. But you're right, the pattern looks very interesting, Michael. Let's go to some individual companies now. Liontown Resources had a big week last week at a time when there's question marks over the oversupply of lithium and all that sort of stuff. What is this chart telling you?
Look, it is a very volatile chart. As we could see, almost day by day, it you know, either looks bullish or bearish. It's just, you know, you get some mega days up, but then you have some days where it falls back down to earth. So we could see since the start of the year it has been very choppy. But at the moment, I'd say there's more of a bias towards the upside. There isn't really much of a range, but to me, it looks like it wants to head higher. And I think obviously if markets start behaving themselves, then it can do pretty well, because for those with a keen eye, you'll notice that it's basically at the same levels as the start of February. So that's when the market started rolling backwards. This one's actually held up pretty well. So that's a good sign for when the market's ready to get going again.
Yeah, it's a real gamble with lithium, isn't it? Like we all know lots of lithium is going to be used in the future, and electric vehicles and the demand for batteries are all going to help a company like this. But we're not quite sure about the total supply going forward. But at this point in time, it looks like a pretty good bet. Let's go to the next one, Michael, and that's Champion Iron. Now, it's a sort of like a junior player, but it's done pretty well, hasn't it, in recent times?
Yeah, I think this one looks really good. I think we had a look at this chart back in December, and it was a good looking chart. What's happened since then is it's rallied up towards its highs in 2022, and then even though on a day-by-day basis it looks very volatile, when I zoom out and look at a chart like this, to me, what it's done over the last several weeks or so is basically just consolidate that really large move from November, December. So what I mean by that is it just rallied so hard in November, December, it had to take a bit of a breather, and that's all it's doing. And that's what I've circled there. And what's interesting about that is that it's doing it just under the high from 2022. So naturally, when a stock runs up to an old high, you get a bit of selling pressure. But instead of the shares falling all the way back down, they've essentially traded sideways in this area that I've circled. So I think there's a good chance once those who wish to sell have done their selling, then the offers won't be there anymore, and I think you'll see it crack through to a new high. Again, those with a keen eye might notice that the price action is very similar to Fortescue, which is a stock that I like as well. So that's consolidating under its 2022 high. It's been holding up very well despite the market falling back the last few weeks, and I think that's a stock that can head to new highs fairly soon as well.
Yeah, it looks like a very good sign. Let's go to another miner, Chalice Mining.
Yeah, so this is a weekly chart here. Again, to me, this looks like it's just consolidating, just trading sideways, getting ready for the next move, which is likely to be higher. So again, the day-by-day moves seem quite large, but what I've indicated there with the blue lines is essentially this is known as a bull flag. So you've got this sort of run up in the end of last year, followed by this sort of sideways movement, looks like a flag. And all we need to see is a resolution. So I think most likely we'll see a resolution to the upside. So if it gets above the upper blue line, then you've got the start of the next rally. And I'm still bullish on gold. We've seen some nice moves in gold recently because interest rates don't look as though they're going to head as high as everyone first thought. So that'll be positive for Chalice.
Okay, let's go. This is an interesting one. This is called HNDQ. It's a beta share ETF based on the top 100 stocks in the NASDAQ. It's hedged, and I sort of got onto this late last year, and it's going okay. What's the chart telling you?
It's pretty much as we can see, just tracking the NASDAQ chart. So yeah, so I guess further to my comments earlier on the NASDAQ, looking like it wants to head higher for the moment. I think this one will, yeah, obviously because it tracks the NASDAQ, this one looks like it's going to head higher, at least in the short term as well.
Yeah, I thought that would be the case. Let's go to Bluescope. Interesting one. A lot of people were negative on it when it was sliding, but it seems to be bouncing out of that negativity.
Yeah, this one looks like it's, to me, heading higher. So there was a downtrend there that I've indicated with the blue line, which was broken at the start of the year. And at the moment, it's got itself into a new uptrend. The daily movements are quite large. It is a fairly sort of volatile stock day by day. So that's why I just put up a weekly chart here just to help filter out some of that noise. But in my opinion, there's an uptrend now, and if I was in this stock, I'd be happy to continue holding it. Okay,
let's go to another sort of controversial one, and that's Megaport MP1. And you know, the markets liked it. A lot of the analysts liked it, but the company hasn't been reporting all that well. And looking at this, it doesn't look great for the short term.
No, unfortunately, it still looks. They're not the best. What I've circled here are various occasions when the stock has just been dumped, and unfortunately, it's, as I've pointed out before with this, you don't want to see those sorts of moves. So basically, as soon as investors have an excuse to sell, they do sell. So I think when we looked at it only in January, it was at $6, and now it's in the $4s, and it's taken out the lows from last year. So it's still not displaying any signs it wants to turn around. And this is in a situation where the NASDAQ looks like it wants to head higher. So that positivity isn't flowing through to this tech stock, not yet.
Yeah, and sometime last year, whenever tech went up, MP1 went with it. So there's certainly a market set against the stock now. Let's go now to Xero. This is one tech stock the market's starting to re-love.
Yeah, that's right. This is the opposite. So in my opinion, Xero looks like it's broken an downtrend. It built a little bit of a base at the start of the year, and now it's getting itself into an uptrend. So this one looks like it's put a low. There's a low in place now, and it's on the way back up. So I think if you're looking for tech stocks locally, this one, from a charting point of view, is doing all the right things.
Yeah. Now, finally, I want to get you to give us one that you like right now, and looks like it's Evolution Mining.
Yeah. So gold. So I'm still, as I mentioned at the end of last year, still positive on gold. I did get back into, we got back into Newcrest a couple of weeks ago, but that's already run in the last few weeks. But what I've noticed with Evolution is a possible entry point right now. So this is a bit more useful to our viewers. What it's done is, like most gold stocks, eased back there in February. Last Friday, it broke the February low which I've circled there. But instead of following through on the downside, today it's jumped up very strongly, obviously on the back of strong gold prices over on the weekend, and also a positive update from the company this morning. So when you get this breakdown under support, only for a stock to gap back up above it, which is what it's done today, that's known as a false break, and often that's quite a bullish sign. So I think if you're looking to pick up a gold stock, I think this one's doing all the right things on the chart, and I'd expect it to recover from here.
All right, Mike, great stuff as always. I guess the bottom line from my point of view is to ask you, if the Fed raises by, say, 0.25% and the banking crisis becomes less of a crisis, do you think the overall feeling is that stocks will head up for 2023?
Yeah, I think, I mean, it almost doesn't matter what I think the Fed does. I'd just be more interested in seeing the market's reaction. I think the market is already, up a couple of weeks ago, was pricing in some pretty dire situations. And I think that, as I say, I think everything's coming to a head now. So we've now looks like we have that end to interest rate rises. It looks like the Fed's doing everything they can to support the banks and offer liquidity. So I think all the ingredients are there for the market to head higher. It's just a case of the market actually doing it. So to me, it's showing early signs that despite all the fear and the negative days like today, it looks like it's waiting for that catalyst. So I think it's just getting the Fed decision out of the way. I think whatever they do, whether they raise by 25 or keep it the same, if we get a decent reaction on the market, then and that's the next buy point. But yeah, look, as I've been saying to my clients, I think with what's happening at the moment, it's not the time to be selling now. If anything, we're looking for the opportunities now, the turning points to start buying and take advantage of these levels.
Okay, mate. Buying opportunity from Mike Gable of Fairmont Equities. Thanks for joining us.
Thank you.
That was Mike Gable of Fairmont Equities. Now let's go to my colleague Paul Rickard of the Switzer report to see what he's seeing with the banking crisis, and is there a buying opportunity for our banks as well? So let's cross now to Paul Rickard. Thanks for joining us, Paul.
Thanks, Peter.
So how worried are you about the banking crisis?
Look, I don't think I'm as worried as other people, Peter. And I think you sort of, we've seen these things come and go in the past a bit. And particularly when we're seeing the central banks line up to act and help, I think you've got to say eventually they're going to get on top of this and they're going to win. That doesn't mean there aren't going to be a couple of nervy days around the corner. And I guess the market's just a little bit worried still as to what the purchase by UBS of Credit Suisse means, and there've got to be some losses somewhere, and just on whose balance sheet are those losses sitting, and that's always something that that markets get a bit nervy about.
Yeah, I heard over the weekend that some commentator was surprised how quickly the deal was done for UBS to take possession of Credit Suisse, and I guess the bottom line was the shareholders of Credit Suisse had no say in the matter.
No, they had no say at all, Peter. And in fact, they're using an emergency power, so it doesn't even have to go to a shareholder vote. Yeah. One of the sort of casualties in this, Peter, though, has been the so-called holders of the so-called contingent bonds, a little bit like our hybrids, but again, they're very different and they're a lot lower rated than our hybrid securities. And apparently they're going to be wiped out. So it's about $17 billion worth of potential losses there. Mm-hmm. Now, the concern for the market, apart from the fact that sort of it's breached sort of, I guess, long-standing market conventions, is that, if you suddenly have a loss like that, who owns these things? Mm-hmm. And on whose balance sheet? And therefore you get sort of rumors spread as to, this fund manager or that bank or wherever it is, and they've got big losses. So there is going to be some damage. And I guess that's why we perhaps haven't seen the markets rebound as solidly in Asia today, as you might have expected this morning coming in, and the news that the deal had been done.
But Paul, the history of all these sorts of things is that because you don't know what's going on, the short-term player in the market is going to be a seller until they find that there's less to worry about, where the long-term player is just going to be there and they'll cop whatever they cop. But the short-term player, it makes sense that they sell first and then wait to see what emerges.
And that's exactly what's been happening, Peter. And also just be a bit wary about the media. I mean, we know the media likes negative stories, and there's nothing better than writing about a collapse or a crisis. Whereas if it's all being resolved, it's not so interesting. So there's a lot of so-called scary commentators out there having a field day telling everyone it's really bad. I mean, I'm taking my guidance. I think there's been some good value in some of the Australian banks. I think you've got to stick with the quality. That is the banks that have the best balance sheets, the best deposit bases, and the best capital structures. To me, that's clearly the CBA. That's the one to stick with. In fact, I bought CBA shares last week in the 93s. Today they're 96. They're sort of close to breaking even on the day, which isn't a bad outcome given how they started. And I think that's where the value is. So you just got to be a little bit selective, but at the same time, I wouldn't say we're out of it yet, because people get nervous, and as you say, the first thing they do is they sell, and then they work out what's really going on. Yeah,
and Paul, do you think, like I know in our case that we only ever, if we played hybrids, we'd only do them with good quality banks like our own. You think they're going to suffer as a consequence of the question mark about hybrids around the world?
Look, they don't appear to have been yet. I mean, that always comes out, I suppose, as a short-term risk. I mean, Chris Joy who's, as you know, the manager of the Beta Shares Active Hybrids Fund, and as he'll keep telling us, one of the smartest guys in the market. He's written a couple of articles today pointing out the very significant differences between Australian bank hybrids and hybrids of the like Credit Suisse. They are very, very different, very differently rated. And look, I guess there could be just a little bit of nervousness up front, but that'll create an opportunity for others, Pete. I mean, I don't think this is going to end up in a crisis here in Australia. I think the central banks, as they've proven before, they'll just line up and they'll do whatever it takes until they've got calm. So that's going to create opportunity, and the strongest banks will come out better than they went before they went into this.
Paul, I wrote last week that while rising interest rates hurt borrowers, bank crises scare everybody. You think it'll be a help to bring inflation down, the fact that there's going to be a lot of nervousness for even savers nowadays?
Look, a little bit. I mean, I guess the central banks are going to have to be careful. Certainly it's going to, it's just enough also to take the edge off economic growth, and that's going to put downward pressure on inflation, as the growth stalls. So that's one of the reasons why the central banks will have to be very careful. But look, I think that they learned a lot out of the GFC. Banks are in such a stronger position from a capital point of view. This is, again, a part of the problem. Reason why this has happened is that, again, not something that happens in Australia, but banks overseas don't always mark to market. That is, they value their assets at the current market price. Now, you and I know, Peter, that a lot of our clients that have been in bond funds have suffered enormous, market value losses last year because bond yields went up. They didn't realize it, but of course they have in terms of the market price. Well, part of the problem here in the US and to a secondary extent in Europe is they weren't marking to market these things.
Yeah.
So the accounting results are false. So we don't have that problem in Australia. It's very different. And I think people need to just be a little bit careful about too much follow the leaders.
And so
I preach the gospel of being calm, and I think this has got some opportunities for buyers.
Yeah, and I guess those banks that weren't marking their bonds to market found out the real value of them when they had to sell them when they're having a run on their bank.
Yeah, and of course you can't do that in Australia, Pete. So again, another difference. It just doesn't come out in some of the sensational coverage around it. So we don't have that problem. Look, it's it's painful for those of us who hold market style investments, but that's what happens when bond rates go up. And again, I just think we've just got to take a deep breath. There's going to be some good opportunities. I think at the right price, stocks like CBA are going to be very attractive. And but we've got a few more days, maybe a little longer than that, sort of just to get through this. And as eventually, I think calm will come back into the system.
Okay, Paul, thanks for joining us.
Thanks, Peter.
And that's Paul Rickard of the Switzer Report. Remember, if you want to know more about the Switzer Report, go to switzerreport.com.au. There we have other analysts looking at other stocks and might give you some great insights into what you might buy or what you might sell. Thanks for joining us. And remember, switzerreport.com.au.